All right. Weekly roundup, Hart Investment Group. I'm Scott Goodfellow, Ben Hart.
Hello.
It is September 8th, 2023.
Important day.
Important
day
day.
in my life. Hey?
Yes, it is.
My wife's birthday, very important day.
Oh man. I hope you have something huge planned.
Of course.
Yeah, I bet. That's awesome. Well, without further ado, let's get right into it. I guess this was a short week because we had Labor Day on Monday. What did you see in the markets as far as that's concerned?
Yeah, it was a short week, but as I think we talked about last week, I thought there'd be a lot more activity as we came back, and that's definitely what we saw. We saw volumes come up. We saw definitely activity. I mean, we talked about the new issue market and potential for companies to come to market, and Enbridge came with a huge deal, $4 billion deal, then Pado, and then Severia. And so a number of companies came to market this week, which kind of indicates that we've had a decent run in that space. Enbridge was for an acquisition, but certainly the activity and the interest and in the oil and gas space has grabbed a lot of attention. So that was interesting action to see. And from a market perspective, we saw really kind of sideways-ish, a little bit down in markets. Bonds were up and down throughout the week, but nothing really changed from a directional, but lots more attention and action going in. Wednesday was the Bank of Canada's announcement, which they did not raise rates, and the GDP numbers were weaker than expected. So that'll be interesting. We'll talk about that a little bit on the chart, or when we go through the chart section. But yeah, no raise for Bank of Canada, which is welcome relief for a lot of people.
Yeah, definitely. Especially our mortgage friends here at National Bank. We see them in the office all the time, and they're often complaining about the rates going up over the last 6 months or 8 months. How long has it been? When did they start raising rates?
Almost a year and a half now, like March
Year and a
of
half. I'm like,
yeah,
6 or 8 months. Yeah, it's
March of
flies by.
22. Yeah,
That's crazy. So yeah, I mean,
yeah,
that's how long we've been hearing the complaining from the mortgage department. But understandably, right? Their job
yeah.
is to get the best rates. So and just as a side note, National Bank mortgages often have the best rates. So if you're looking for that, shoot us a note and we will
Yeah,
send a referral on. Little plug there for our mortgage guys.
that's
Okay.
right.
All right. Well, is anything else you want to talk about before we get to those charts?
I don't think so. I think definitely got a few things to go through there. Maybe touch on a couple of other things at the end, but I'm ready to go if you are.
Okay, awesome. It does look like some people were able to join, which is great. We're on a new platform here. We're using Microsoft Teams, which I know when you change platforms can be a challenge for some people, but it's a better fit, and it's our compliance department likes it much better too. So let's get into it.
Exactly. Yeah, so we're making our way to it. Hopefully, everyone can see everything and get used to it, and the videos will start to get updated and uploaded on time as we figure out the systems to get there. So yeah, I put this out. I think I put this out. If I didn't, I certainly intended to, but this was on Tuesday when we came in. This was the data, what it said. Canada, we had the meeting on Wednesday. As I said, odds of a hike was 10%. So that was accurate. The 90% were right in this case. So as we head towards the FOMC, which is the Federal Reserve in the U.S., they presently 7% likelihood of a rate hike at their next meeting. So it's not next week, but the following week. So we certainly watch that quite closely, but continues to say that we believe that the top is in that space. I did put this out. I think I put this out in the daily. If not, I certainly commented it on the short and just give an update on what this means. But I thought it was worthwhile to discuss because I had a few clients actually ping me and ask about what specifically this chart was saying. And so if we look at this would be the big six banks, so TD, CIBC, BMO, RBC, Scotia, and National. And so we've talked about this a little bit in the past, but there's two types of variable rate products. One where there's a fixed payment and then the principal adjusts depending on what interest rates do. So that's TD to RBC, those four. And the other is Scotia and National, which they have a variable rate product that adjusts as the interest rate adjusts. So they have people with National Bank and Scotia. Their payments have been adjusting as the interest rates have. However, the other four have not. And so when we think about amortization and rates in Canada and such, when I post this up, some clients said, "Well, 25-year amortization, that seems normal." Well, the limit presently right now is 25-year amortization. Anything above that, you have to make an adjustment either to your payment or refinance or something along those lines. So we've never seen the levels like this where in TD's case, roughly 50% of their book has amortization over 25 years. So this is really to show the amount of strain and stress that's been put into the system there, which means that these four banks certainly have residential real estate risk to think about. Scotia National, obviously, they're in a position of power because people have been adjusting their payments as things have come up. And as rates start to come down, they'll at least have the ability to access capital and be able to finance future mortgages. So I thought this is super interesting. I'd never seen it laid out this way, but amortization's gone way out there in a lot of cases. Some people's amortization is 100 years, which isn't allowed, and changes are being made quickly, but interesting chart. Hopefully that brings a little bit of clarity around that chart. So Stefan Marian, who's our chief economist, put this out today. And so, there's obviously a number of different places from where inflation comes. And this is one that's been putting upward pressure on inflation over the last 12 months. And so this shows that wage inflation is starting to roll over, certainly rolling over. And that should go from being a driver of inflation to a detractor. And you start to see that the wage inflation numbers start to come down. Some of it is jobs and so on and so forth, but certainly in Canada, you're starting to see wage inflation come down. So this always grabs my attention when I read this headline. It says Goldman Sachs plans fresh round of job cuts for underperformers. So it's don't do as I do as I say, or something like that. Because if you look at what their forecasters are, Goldman Sachs came out last week saying the risk of recession is pretty small at this point now. Yet on the other side, what corporate is doing is they're firing people and laying them off and cutting pay and so on and so forth. So which one is it? I think probably the latter, that this one is worth paying attention to seeing what they're doing at the corporate level, as I think it probably has a bigger impact than what the forecasters are saying in this case. Two more quick ones, but this certainly grabbed my attention this week. It has been flipping around in different circles just to get a sense of how material the unintended consequences. I think I put this in the daily as well. So, as central banks started to raise rates at the fastest pace in history, what we saw is money started to say, well, that makes sense to no longer leave my money in the bank because over, this extended period of time, you could leave it in the bank and it wasn't a big deal because interest rates were pretty close to zero bound for, well, at least for this period of time, this decade here. But now, and people have been drawing a lot of comparisons to what happened in 2008 versus where we are today. We had something in the neighborhood of 70, $80 billion leave the banks and go into money market or high savings or so on and so forth. And if we look at the steepness of this, we're heading towards $1 trillion leaving the banking system in the US this year. So as rates have gone up and the banks haven't been matching what money market or high savings can get you, you've had close to $1 trillion leave the banking system. So this was, this first chunk down, that was when you started to see the regional banks get into trouble. That's when Silicon Valley and such went out of business. And now we've had successive waterfalls putting further pressure on deposits. the banks are actively using the central bank to give them liquidity and so on and so forth. But this is a major number and has an impact on what's going to happen to the financials. If they don't have any deposits, they can't lend any money. And just the last chart that I've been putting up the last couple of weeks says these are the major variables that come into macro. And so unemployment, inflation, and GDP. These are the two: current account balance and M2. M2 is certainly important from a flows perspective. So I start to watch that from a what's happening in the market. So M2 is rising, tends to be a real positive for risk assets, but M2 is pretty neutral right now. Unemployment, as I mentioned, starting to see a tick up. Inflation, we have come down pretty hard and now are settling around that kind of 2.8 to 3.2 levels. So we'll see how that plays out, but inflation probably stays around these levels for a couple of months. And then GDP, which is starting to head back towards that zero level. And as I think I commented on one of the dailies this week, you're just talking about what's happened to GDP in Canada, and it shows how far the Bank of Canada is off in their forecasting. You need something close to 4% Q4 GDP growth in Canada to get anywhere close to where they think GDP should be this year. So actual data is showing GDP slowing very quickly in Canada. And that inflation number is a little bit sticky, but if GDP continues to drag down as quick as it has been here, we'll quickly get towards that number that the Bank of Canada is looking for. As an aside on that one, some of you may have seen Krista Freeland talking about how the Bank of Canada needs to quickly cut interest rates as quickly as possible to help Canadians. So we're seeing some political bantering with some of the politicians talking about that. Doug Ford said the same thing as well, but interest rates are starting to really get politicized here, and it's worth paying attention to at this point.
All right. All right. Good
Yep.
ones. All
Yeah.
right. Some good ones there. Yeah.
Yeah.
You touched on mortgages too. It's good. Nice little segue there. Good for you.
Yep.
Okay. So what do we see in the crystal ball here for next week?
Yeah, so be continuing to follow what's been happening. And I think in Canada's case, we've seen really that GDP go down quickly. And so as you start to hear comments around what happens next, I think that's going to play a major part in what happens here. The jobs layoffs we're starting to see pick up quite quickly. And that's certainly what I'd be watching. And, in the US, we'll continue to watch what the Federal Reserve's doing. But, on a week where they weren't really supposed to say anything, they had, 6, 10, 8 Federal Reserve speakers trying to calm things down. And so we'll be watching that. And President Biden certainly has been having some struggles with communication. Mitch McConnell's come out. I don't know if you saw him this week as well, where they kind of had to prompt him a couple of times because he forgot what he was talking about in meetings. So, hopefully they're people are starting to say maybe we need some different individuals in power. And so certainly be watching how that plays out.
Okay. Any parting words before we head into this birthday weekend for you?
I'd say what we've seen, which is interesting, is oil has really rallied here in the past 6, 8 weeks. And so as we start to move up to that $90 a barrel in the US, we have had lots of questions about that. Are we in the top end of the range? What's going to happen? This is a little like in 2001, where we saw oil rally hard into a slowing economy. So that number will be important to watch, because if we see that continue to creep up, that probably puts further pressure and expedites the recessionary numbers. So I'll be watching that. And, Biden's talked about the SPR, which is kind of their strategic petroleum reserve. They haven't been using it in the past couple of weeks, so be worth watching to see if they decide to turn some back on, because a lot of these energy companies that I follow are getting close to 52-week highs again. And so we'll continue to watch and see what there is, if anything, to do in that case. But I think oil is going to play a major part for how things go over the next couple of weeks.
Definitely. Okay, great. Yeah. So for anybody, probably should have mentioned this earlier, but all the buttons now are at the top of this platform. So in Q&A, you can put it in the Q&A or chat. I know we're at the end here, so kind of missed that opportunity. But for moving forward, this is the platform we're going to use. We think it's a lot better for a lot of reasons, and we will get it figured out and dialed up over here in the next few weeks. All right, everybody.
Absolutely.
Well, thanks so much, and we'll see you next week.
Sounds good. Thanks. Take care, everybody.